Right. Morning, everyone. Welcome back to Morning Kappa at 8. I'm Joseph here. Hope you had a very good weekend. Let's start off with the market update and look at the Hong Kong market. We can see that last Friday, the Hang Seng Index continue experience this profit taking, and right now it's went below the 20 days moving average, showing that on a short-term basis, the bullish momentum have slowed down significantly. Nevertheless, I still think that very strong support should be at this 23,000 point level. So as long as the Hang Seng stay above this 23,000 point, right, the bulls still have the technical advantage, right? Despite that, Hong Kong market is experiencing profit taking right now. We still keep bullish trading buyers, and so these are some of the stocks that we think that you should put in your watch list. And as of this morning, we'll be on the defensive side. We'll look at the China Telecom 728, which last week you have break past 6 Hong Kong dollar. So it should move towards 6 Hong Kong dollar 30 cents and followed by $6 60 cents. Downside support will be at 5 Hong Kong dollar 70 cents. Secondly, we have the EV related counter NEO 9866, which I have posted a very good number of sales last Friday. We can see that the NEO have jumped above the support, and right now testing a resistance at 38 Hong Kong dollar. So a breakout happen, that will resume the upward movement towards 41 and followed by 44 Hong Kong dollar. Downside supports market at 35 Hong Kong dollar. Meanwhile, looking at the Euro market, as we can see last week, Trump have reviewed the trade deals with quite a number of regional partners, and the EU have a deal at 15%, but much details have to be ironed out. Nevertheless, the Friday saw the sentiment have turned negative, as you see that SXSP, this European index, have fell below their 50 and 20 days moving average. So right now it's testing this very important support at 535. On the downside, 200 days moving average also will give support as well. Now, in the event that this XXXP fell below the 525 point level, which is going to erase the gains since month of May, then on the overall technical setup will be bearish. Right now, we'll deem this at consolidations that since May period. So let's see this week whether XXXP can stay above this critical support at the 525 level, which is the low point since month of May. Then on the US market also have a gap down last Friday and charted a lower low after news saying that the US have a much worse expected number, and Trump have just fired his this labor statistics chief, and I think that right now Trump also have deadlock with the Senate that a few key positions nominees did not approved by the House yet. Hence the sentiment right now turned negative on the latest development, and nonetheless a very strong support should be somewhere at 5,008. So let's see this week, since the US is undergoing corrections, whether it can stay above 6,001 this level. So last week, the Microsoft, Amazon, right, Meta, Apple have released their result. Despite a better number of results, the companies are saying that the tariff may actually hurt consumer buying down the road. Hence, the market tends to be on profit taking last Friday. Now, meanwhile, we do see that the US 10-year yield have fallen sharply from about 4.4% to about 4.2%. That also moving towards our target, our economist target at about 4.1. Now, when the US yield is actually moving downwards, that actually give us a bit of information here that our market is pricing slower GDP growth, right? And that's what the message right now, and the market have going into more risk adverse right now. The funds actually moving out from equities, they are going into the bond market, and as they are buying the bond, it actually pushed down the yield so far. Okay. Right, so these are the US stocks watch list, and right now the FPM TLCI are still seen consolidating below the 1550 point level. Now, overall, if we are looking at the weekly chart, you can see that FPM TLCI managed to stand above their 20-week SMA line. So as long as stay above their 20-week, right, the technical setup remains favors to the bull. And last week, the market leader was constructions, technology, and energy. Right, last week, government also have unveiled the 13 Malaysian plan, and we also get exemptions from the semiconductor exports. And but we do see that profit taking happens in the healthcare, telecommunications, and as well as the utilities sector. Right, construction sector has been leading the market so far, not only last week, but since it actually went out from the April, right? And overall, our research still have an overweight call on the construction sector. Then on the consumer sector, we have a neutral call, and the consumer sector's index have been moving sideways, but we do see a few stocks that have actually outperformed the market, such as EcoShop. That we have a technical report last week, and also our analyst Wei Xiang have initiates a report on EcoShop as well. So despite that the sector index is moving sideways, there are some stocks that you can actually look at in the consumer space. Now, meanwhile, last week we have managed to cleanse a 19% tariff with the US that actually have better than the market expectations, and the bank have charted positive price actions last Friday. Let's see whether these price actions can follow through this week, as we can see that finance index has been undergoing corrections since it's trading below the 20 days moving average. Now, meanwhile, property sector also have a rebound on the last Friday. Afterwards, Horng is going to talk about the property sector. As for the technology sector, it also moved higher last week, and so far, based on the technical setup, technology index is showing a bullish posture so far. Now, we still keep bearish bias on the FKI until it break past the resistance of 1550. Now, meanwhile, FTPO have a rebound from the 4002, and we keep our support or our stop loss level at 4001. So as long as this FCPO stay above the 4001, recent corrections is mere a healthy pullback, and we think that overall setup remains bullish so far. So these are the Malaysia trading stocks watch list that you can actually take a reference. Meanwhile, for trading stocks this morning, firstly we look at Penta Master, eyeing to break past 3 ringgit and 60 cents. Breakout happened, Penta should climb towards 3 ringgit 75 cents and followed by 3 ringgit 90 cents. Downside support 3 ringgit and 45 cents. Secondly, we have the Dialog, break past 1 ringgit and 75 cents on a high volume. So Dialog should climb towards 1 ringgit 85 cents and followed by 1 ringgit and 95 cents. Downside support marked at 1 ringgit and 65 cents. So we have one breakout stock, Penta Master, and followed by Dialog. So I stop here and pass on to Godwin on the property sectors update. Thank you.
Okay, thanks, Joseph. So moving on to the property sector, in a recent meeting with Singapore Prime Minister Lawrence Wong, our Johor Chief Minister Dato' Onn Hafiz has proposed the possibility of a second RTS link connecting Tuas and Iskandar Puteri to further enhance cross-border mobility. Although there's no further elaboration and feedback mentioned in the media reports, our view is that the proposal is nonetheless positive for the long-term growth prospect for Iskandar Malaysia, especially for developments located near the second link, i.e. Iskandar Puteri and also Nusa Jaya area. So key land bank owners in that area will include Sunway, UEM, Sunrise, Ecoworld, and Masing. We applaud the idea to have the second RTS, although we do not expect any substantial progress on this over the medium term, The proposal made by the CM is nonetheless indicating the state's long-term plan or long-term goal to enhance the cross-border infra for Iskandar Malaysia, and also, make JSSEZ a success. So recall the ongoing RTS that will be completed in end 2026 actually took more than 2 decades to materialize. It was first mile in early 2000s, and when currently the daily passenger traffic is almost 300,000, and likewise over the longer term, for the second link side, we expect the daily passenger traffic to also rise from the current 165,000 as the Iskandar Puteri area sees more industrial and also commercial activities over the medium term. So back to property development side, Sunway secured the TOD, the Integrated Mixed Development project from MRT Corp early this year. This is the RTS Bukit Jaga project. So in our opinion, Sunway will likely price its first service apartment from 1,800 per square foot onwards upon its launch in third quarter 2028. So this pricing is very much similar to some of the high-end condo pricing in the KLCC market. And we think this is possible as the project will be built on top of the RTS link, and the link will be up and running by then, creating a good visibility on the proximity and also convenience. Just to make a comparison, the ASP for the private resi at Woodlands is now going at 1,008, 1,009 Sing per square foot, and hence, given the price differential and the distance, which is essentially just one stop away, just 4 km long and 6 minutes ride, the demand for Sunway's project should be very encouraging among Malaysians and Singaporeans. So the current ASP for projects near the RTS is now going at 1,002 to 1,004 ringgit per square foot, and is well supported by a strong rental market. And for some fully furnished studio units, the rental rate is now at 450 to 5 ringgit per square foot. So it's also comparable to the KLCC rental market, or even like Mont Kiara. So it's worth watching out the response for some of the upcoming new launches in Iskandar Malaysia, and this include the new project by UA Development, M Grand Minori by Masing, Eco Botanic Tree by Eco World, and also Sunway Soho at Yaya Awal. So overall, we maintain our overweight rating for the property sector. Our sector topics are Sime Darby Property and also Sunway. Okay, let me stop here and I pass to the next speaker, Meng Horng.
Thank you, Godwin. Let me just move on to, Inari Amerton. So they have just announced that they will, together with Sanan Auto Electronics, acquire 100% of Netherlands-based company Stimulets for a total enterprise value of $239 million. Now, Stimulets is among the top original equipment manufacturers for aftermarket automotive lighting and accessories, including camera flash, as well as the camera flash for mobile devices, micro LEDs, horticulture, and so human-centric lighting. Now, this acquisition includes its 11 subsidiaries across Asia and Europe. For the numbers wise, I think Stimulets were making losses in both FY24 of $67 million, as well as the first quarter of FY25 at about $17 million. Now, in terms of the price tag, we believe it is fair in view of the Stimulets' financial performance, as well as the entire industry headwinds. At a price to book of 1.1 times, it is rather attractive. However, if you going across, the negative performance over the past few years, then we believe, the current price, tag is also fair. If you benchmark against the net asset of 210 million of Stimulets as of FY24, and also appraised, market value of 287 million. Now, the final consideration will be adjusted for net cash, debt, as well as a working capital. Further to that amount, I think both Inari and San'an will inject the USD 41 million worth of working cap post acquisitions. Now we are neutral in the short term, but positive in the medium term, as we believe these acquisitions will enable Inari to diversify its revenue stream, boost its exposures to the key growth areas, ramp up its vertical integration, and expand its manufacturing capabilities. After all, this will also improve its ROE through the strategic cash deployment. Now, the 25.5% owned by Inari, will be an investment in associates. When it comes to the P&L, the entire stake of 25.5% will cost Inari about 71.4 million, which is 307 million ringgit, which represent about 9% of its total asset and 14% of its total cash pile. This funding will be mainly from the placement exercise done in 2021. Now we expect some operational synergies from the technical capabilities of San'an as well as Inari, resources reallocations, and also some cost optimizations post deal, with potentially turning around Lumileds by 2027 or 2028. So if just assuming the losses are narrowed by 50%, the potential earnings impact to Inari in FY27 is estimated at about 8%. However, we have not factored in all this into our forecast, pending for more guidance and completion of the deal, which is expected in third quarter of 2026. I think the key risk, from this deal will be approvals, from various authorities, execution, and also as well as the market dynamics in the LED as well as SIC and GaN, subsegments. Now, no change to our target price, and target price remain 2.45 ringgit. We're still keeping our buy call on the stock. I'll just stop here and pass on to the next speaker.
Okay, thanks, Meng. So we have a company update report on Axis REIT today. Still keeping our buy call and 2.23 target price. Axis REIT announced that it has entered into a conditional sales and purchase agreement to acquire a logistic warehouse in Port Klang for 80 million ringgit. This acquisition will be fully funded via borrowings. So post-acquisition gearing will increase from 32.7% to 34.3%, and the transaction is expected to be completed by fourth quarter 2026. The property offers a total net lettable area of 259,000 square feet, and it sits on a leasehold industrial land parcel of approximately 10.2 acres. So the property is fully leased to Taksan Logistics on the 6-year term at a monthly rental of 425,000 ringgit. We are mildly positive on this acquisition, while relatively small in scale, given that it is only 1.5% of Axis REIT total asset. The acquisition supports Axis' ongoing strategy of delivering consistent inorganic growth. The purchase price implies a decent gross yield of 6.4%, which is reasonable given that the asset is fully leased under a 6-year term and strategically located within a key logistic hub in Port Klang. It is also slightly higher than Axis' current dividend yield. So we raised our FY27 earnings by 1% to reflect the new rental contribution, while also adjusting for the additional financing costs. And given the minor earnings adjustment, we keep our target price of 2.23 ringgit. We are still keeping a buy call. We remain positive on Axis REIT as a proxy to the resilient and growing industrial property segment, and with ample debt headroom, a more favorable interest rate environment, and a solid track record in executing new accretive acquisition, we believe that Axis REIT is well positioned to continue expanding its industrial portfolio. Yeah, that's all from us today. See you guys again tomorrow. Thank you, everyone.